Good afternoon, everybody. Today is Friday. It's the 28th of March, 2013. This is Brian Shannon from alphatrends.net speaking. And let's take a look at this market. We finished the week and the quarter positive here. S&P 500 up 10% for the quarter and into record high territory as the path of least resistance continues to move higher. Pretty much for all of these markets, gold is still in a downtrend and it's declining. There is no flight to safety in terms of gold. It's been the opposite for that. And we'll take a look at gold as well as some of the other things that we look at each week here. By the way, if you're listening to this on YouTube, it seems as though there's an issue of audio going up and down, and it seems like it's just YouTube. So go to alphatrends.net and then look at the video there because I'm going to upload it using another service. Let's take a look at this market. Again, we are at all-time high territory for the S&P 500, and it shouldn't be a surprise because we continued to hold above the key levels of support. Last week, last Friday that is, we noted that we were holding still above that rising 20-day moving average, and that as long as we held above key support at about 153.50, that the benefit of the doubt goes to the buyers that we were experiencing a correction through time rather than a price pullback. And what we had seen was that we were getting higher lows here the last couple days. That's something I pointed out to Alpha Trend subscribers the last couple sessions, and that a new high shouldn't be a surprise when we are in a primary uptrend and the market has digested the gains through time. So we want to continue to focus on key things such as we'll look at next week. I think that the direction of the 5-day moving average will be important. And this is a little band of prior resistance which we'll want to see hold as support. That is basically between 155.80 up to about 156.20. This is what we would like to see hold as a first level. If it breaks below that, then perhaps we'll come back down towards that 153.5 level. But for now, we continue to remain bullish and give the benefit of the doubt to the buyers. That's what we need to do. And as I'm going to write on the blog here, you have to ask yourself, would you have been better off performance-wise not knowing about some of the news headlines? And I've been criticized a little bit about continuing to call the news out of Italy, the news out of Cyprus, and any other news that seems bearish. I've been criticized for saying, listen, it just is irrelevant to the market. It's not. It is irrelevant to the market in terms of price. The news makes us form these opinions and say, here, this doesn't sound logical. And the market doesn't always trade on logic. They say sometimes that it trades to the intelligence of the lowest common denominator, and maybe people are just chasing prices. Whatever the reason is, whether it's the Fed and their POMO, whether it's algos or just shorts getting squeezed, we don't really need to know the reasons why so much. As humans, we want to assign a reason, but why can't price action be the reason? The path of least resistance is higher. A trend once established is more likely to continue than it is to reverse. This is basic technical analysis 101. We were going to continue to give the buyers the benefit of the doubt as long as we remain above key levels of support. It's not going to get you out at the top, but it's not going to get you out at 100 other false tops when you freak out about every little pullback that comes on a news headline. So the NASDAQ is very close here as well. It poked up through that 69 level, but this NASDAQ is behaving very bullishly here. It held above the key level of that 50-day moving average and what we were talking about as 67.80 up to about 68.20. That's the level we wanted to see hold this week. We did see that happen. We see the higher lows in here as well, and we see it poking away at this $69 level. A little pullback wouldn't be a bad thing for it, and then to push out through 69 and hold. But I think that it's looking like the NASDAQ should be headed for about 70 on its next run, and right now we'll keep an eye on, I think, as a key level for next week, about 68.50. So really 68 and a quarter to 68.50. That's the level we're going to want to see hold. But we're right up to the top end of that range. A little pullback and then breakout would be really a better scenario, I think. The Russell 2000, again, this market has had a hell of a rally this quarter. We're up, 11.99%. And we see that, again, we had a price pullback here, and this consolidation has just been that. It's been a time consolidation above a rising 20, 50, 100, 150, 200. etc., all these moving averages, and we're in all-time high territory. There was no triple top for the Russell 2000. It just continued to move higher. To call the S&P 500 a triple top, it's an area where we've found resistance before, but it's not a triple top. We'll know that in hindsight whether it's a triple top or not. It has the potential, I suppose. But right now, back to the Russell 2000, we came into this week again saying that there's a potential scenario of maybe it would do something like this and break down, but we wanted to give the buyers the benefit of the doubt that it was a time correction as long as we remained above 93. We held 93 all week, and we got up to some important levels here, 90, 94.70 up to 94 at 95. This is our little band of resistance for now. A little pullback early next week down in towards maybe 93 and a half wouldn't be a bad thing, and then break out. But again, I'm going to say that next week you continue to give the buyers the benefit of the doubt as long as it is above $93. If it does that, then you just say the path of least resistance is higher. It's innocent until proven guilty. Maybe you think it's going to decline, but there's no point in getting involved on the short side until prices actually begin to show a pattern of lower highs and lower lows, and we don't have any of that evidence yet. So if you're bearish, just stand on the sidelines and wait for your position to reveal itself, rather than trying to force your opinion upon the market. This is because the market's not going to listen. Basically, the market's going to do what it wants to do, and right now it wants to continue to move higher. The semiconductors didn't come down and test that bigger level, but they did bullishly get back up above this little band of resistance that we were focused on, and that is basically in this little area here at about 35.40 is what we were talking about. So we'll want to see 35.40 hold as support, but the bigger picture here is that we have a range of about $34.50 up to $33.40 up to 36, and that range overall comes within a primary uptrend for the semiconductors. So we're into the midpoint of the range. It's still a range-bound market. It's nothing to get excited about, and it's certainly nothing to get bearish about. You could make the case that, well, maybe it's going to be tracing out a right shoulder. We'll deal with that if it comes down. I always hear the phrase, it always ends badly. It does not always end badly. It only ends badly for those who are unprepared and don't know the key levels to get out from the market and lock in their gains. It doesn't have to end badly if you have a consistent method which you apply to the market, which for me is based on market structure and trend alignment. That's what I wrote my book about. So let's take a look at the financials now. The financials held above their key level at about 1795 to 1805, and right now this market continues to be in a little bit of a range bound. We spoke last week about it not being bearish, but instead maybe more neutral here, and that we wanted to stand aside in cash while we have that indecision. So our little range right now is 1805 to 1830, and this is a group that 1805 to 1835. This is a group that people said, well, we probably have exposure to those Cyprus banks as well, and that's going to hurt our banks. Well, it's not on balance so far hurting our banks. If we get below 1805, then perhaps we pull back a little bit down towards the 50-day moving average. I don't see it as something that would crush this market. We've got a solid uptrend, and that trend line is met there as well. So for the financials, the first quarter of this year, they were up 11.1%, which isn't supposed to happen, but the market doesn't do what it's supposed to do based on common sense, basically, and reactions to news. Put your opinion of the news aside, or just, it's good to be aware. Obviously, you want to be aware of what's driving the psychology of the participants, or what you perceive as driving the psychology of the participants. But the average person has been worried about this market, yet the average price continues to rise. So there's a point where you have to say, hey, my opinion is wrong, the market is correct. The Dow Jones up at all-time highs as well. And gold, again, is still in a downtrend. This was the so-called flight to safety in here, and as I pointed out last week, we are still in a downtrend. We're below a declining 50-day moving average, and it seems more likely to me that we'll get a test of this bigger support level near about 148 or so than it is likely that we'll continue to that we'll rally up. And if we did, then I would expect there to be significant resistance up near here. But we have a declining 50-day moving average. I pointed that out that on the blog, so go to alphatrends.net, that people get bearish under when a stock gets below a 50-day moving average. If the direction of the 50-day moving average is sloping higher, like it is in Visa, oftentimes that's a trap. We spoke a lot about Apple, and I said, breaking the trend line doesn't mean it's going to reverse. And last week, I went out of my way to say that I thought that it was going to bring in a lot of uneducated money, that is, people buying the stock because they thought that it was a good purchase if it got up to above the 50-day moving average, when it's more important to recognize that the slope of the moving average is declining and that these rallies will typically fail, that if the stock is in fact putting in a bottom, this is part of the bottoming process. It isn't just it turns around all at once. Apple has had a good rally, and as I had pointed out, this is the volume weighted average price for the year to date. So the market got right up to that level, and if we take a look actually at the Fibonacci of the 555 high down to the low for the year, we came in right at that 38.2% retracement as well. So for this big range, 38.2% retracement brought us right up to almost exactly the high for the week. We had resistance, as we have already this year, at the declining volume weighted average price year to date, and those are significant events to know. I posted on the blog on Thursday that a potential level of support was the volume weighted average price since the earnings. So January 24th, they reported earnings. The stock gap down. A week and a half ago, we found support at that level. The market came down, and that was a potential level of support. It obviously didn't find any support there. Instead, what we want to look at now is we want to say, okay, so for the for this most recent rally off of the lows near about 419, here's what we have as the volume weighted average price. So let me just redraw that in, and I'll show you how I'm doing that. If I go to this volume weighted average price pencil, I can just take it down here at the low, and you can see that the volume weighted average price is right there at about 442, where we are for the year. I'm sorry, since the low for the year through this week's high. We also are at the 20-day moving average. So maybe there's some buyers based on Fibonacci at this level, or the volume weighted average price rather. Maybe there's going to be some buyers or short covering at the 20-day moving average. But right now, Apple is still in a downtrend. If you look at it, it gapped down below that declining 5-day moving average, and it's continuing lower. And here's what we have the potential for now is if we take a look at, and I'll just draw this in here, is the Fibonacci off of the, so let me just clear that out. And if we take the low for the year up to this week's high, you can see a 61.8% retracement brings us into this prior area of resistance at about 438. And then we could also take a look at a trend line here and say maybe 438 is something that looks 438 to is something that looks reasonable for the week ahead, that we could continue down into that range. But again, the path of least resistance overall in Apple is in a downtrend. You can draw this trend line and say it broke the trend, and that's accurate to say. However, it doesn't mean that we're now in an uptrend. It means if they didn't scare you out during the decline, they'll typically wear you out price-wise. It's not something that changes hands automatically. We've still got a very damaged market in Apple, and I don't mean to go on and on about it, but I know a lot of people trade it. It's a great trading stock. So enjoy your long weekend, and happy Easter to everyone. I will talk to you next week. Thanks.